How did Uruguay, once celebrated as the Switzerland of South America for its stability and prosperity, end up stuck in economic quicksand in 2025, struggling to find its footing in a rapidly changing world? After a brief rebound in 2024, warning signs are everywhere: slowing growth, stubborn unemployment, high interest rates, persistent inflation, and a government running out of fiscal space to maneuver. The 2024 recovery was just a sugar rush after a devastating drought. Now, the hangover is here, and the consequences are being felt across the country. Growth is forecast to slow to around 2.8%, barely enough to keep up with population needs or drive meaningful progress. Uruguay's slowdown is a tangled web. Global headwinds, tough policy choices, and deep-rooted structural flaws all play a part. Businesses are hesitant, jobs are scarce, and the government's options are limited by both internal and external pressures. We'll break down the 5 main culprits: faltering GDP, persistent unemployment, tough central bank policy, sticky inflation, and rising public debt. From rural farms to Montevideo's offices, we'll see why the government's hands are tied and what hard choices lie ahead for Uruguay's leaders. Understanding this slowdown is about more than numbers. It's about whether Uruguay can regain its lost momentum or settle into a new era of stagnation and uncertainty. Let's look at the numbers that define Uruguay's current economic landscape. These are the figures that keep Uruguay's economists up at night as they try to chart a path forward. GDP growth rebounded to 3.5% in 2024 after a severe drought, but 2025 forecasts are a sluggish 2.5%, not enough to create jobs or drive real progress for most Uruguayans. Unemployment hovers around 8%, up from under 5% pre-pandemic, despite a normal labor force participation rate, leaving many families concerned about their future. The economy simply isn't generating enough jobs, pointing to deeper structural issues that go beyond short-term cycles. The central bank's main tool, high interest rates, remains at 9.25% to fight inflation, making borrowing expensive for both businesses and families. Inflation has cooled slightly to about 5%, but it's still at the upper end of the target, so rates won't drop soon, keeping pressure on the economy. Meanwhile, public debt is rising, now over 57% of GDP, and the government runs a deficit of about minus 3.2%, limiting its options. High debt and deficits mean the government can't spend its way out of trouble, even if it wanted to. With limited fiscal space, Uruguay is exposed to further shocks, whether from global markets or climate events. The numbers paint a picture of an economy stuck in low gear, with few easy fixes and many challenges ahead. Uruguay's economy is like an engine with misfiring pistons. Agriculture bounced back in 2024 with 11% growth after the drought, but that was a one-time boost. In 2025, agriculture can't carry the economy again. Industry is struggling. High interest rates make loans expensive, and weak demand means factories and construction sites are slowing down. The services sector, Uruguay's largest, is also losing steam as cautious consumers cut back on spending. This creates a vicious cycle. Less spending means fewer jobs. The result? Agriculture's comeback can't be repeated, industry is squeezed, and services are stalling. The slowdown is broad-based, not limited to one sector. Without all sectors working together, Uruguay's economic engine sputters. The 2025 malaise is spreading, making recovery even harder. The country needs more than a single sector to spark real growth. Uruguay's economic slowdown is rooted in deep, long-standing structural challenges, especially in the labor market. Unemployment is high, but the real issue is a persistent mismatch between workers' skills and the jobs that are actually available. The education system isn't producing enough workers with the technical and digital skills that modern industries increasingly need to stay competitive. This widening skills gap drags down productivity, limiting both wage growth and the country's overall competitiveness. Productivity growth remains weak, making it hard for businesses to pay more, hire new workers, or expand their operations. On top of that, Uruguay's population is aging, meaning fewer workers, more retirees, and rising pressure on pensions and healthcare systems. The shrinking workforce and growing social spending are putting additional strain on public finances. These structural cracks were present before, but the current slowdown makes them impossible to ignore any longer. Fixing them requires ambitious, long-term reforms in education, labor markets, and pensions, not just tweaks to interest rates or short-term fixes. Without bold and decisive action, Uruguay risks facing years of slow growth and persistently high unemployment. Uruguay's central bank is stuck in a no-win situation. To fight inflation, It keeps interest rates high, over 9%, but this chokes off growth and investment. High rates make loans expensive for businesses and families, stalling spending and hiring. The bank can't risk letting inflation run wild, but its medicine slows the economy even more. It's a delicate balancing act. Lower rates too soon, and inflation could surge, keep them high, and growth suffers. The central bank is waiting for clear signs that inflation is under control before easing up. Even then, any rate cuts will take time to boost investment and jobs. The effects of tight policy in 2024 and 2025 will linger, making recovery slow and fragile. The bank's challenge is to avoid both runaway prices and economic stagnation. For now, the path forward is narrow and uncertain. Uruguay's economy is deeply tied to global trends and its giant neighbors, Argentina and Brazil. Global slowdowns and trade tensions create headwinds for Uruguay's exports and tourism. Instability in Argentina or Brazil hits Uruguay hard, threatening jobs and growth. Investors are wary. They see slow growth, high unemployment, and rising debt. This caution makes it more expensive for Uruguay to borrow and limits new investment. Fewer new projects mean fewer jobs, feeding the slowdown and investor anxiety. Uruguay's export basket is strong but undiversified, leaving it exposed to swings in global commodity prices. While trade surpluses and reserves offer some buffer, external risks remain high. The country needs a credible plan to reassure investors and diversify its economy. In mid-2025, Uruguay faces a web of challenges: slow growth, tough job prospects, tight monetary policy, rising debt, and deep structural flaws. The brief 2024 recovery is over. The reality is a return to low growth and uncertainty. The big questions: can the central bank lower rates without reigniting inflation? Can the government reform pensions and taxes without stalling the economy? Will leaders tackle productivity, education, and aging? Uruguay needs a new engine of growth, one built on skills, productivity, and investment, not just agriculture or government spending. This means tough reforms and a policy environment that encourages innovation and investment. The country stands at a crossroads. One path leads to stagnation, the other to renewal. The journey will be hard, but Uruguay's tradition of stability and sense can guide it forward. The prize, a dynamic, thriving Uruguay, is worth the effort. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.